Let us move to different types of leases. So for lessor, you need to classify whether the lease fall under finance lease or operating lease. So because this classification will impact the accounting treatment and disclosures for the lessor. This is for the lessor, yeah? A finance lease. What is a finance lease? A finance lease is defined in the Appendix A of AASB number 16 or FS number 16 as a lease that transfers substantially all the risks and reward incidental to ownership of underlying assets. If there is a significant substantial transfer of risk and reward incidental to ownership, so this will fall under finance lease. Whereas operating lease, a lease that does not transfer substantially all the risk and reward incidental to the ownership of the underlying assets. So if, for example, the lessor sign a contract with a lessee that will result of transfer of ownership and right, risk and return, risk and reward, so that will fall under finance lease. So it should be removed. It should be removed. The asset should be removed from the balance sheet of lessor. Okay. So let us look at this classification guideline. To help the lessor in classification process, the standard set out example or indicators or situation that either individually or in combination would normally lead to a leasing being classified as a finance lease. Okay, that's a guide. I'm going to show the detailed guide from in your textbook. Yeah. Okay. So further classification of finance lease by lessor. Finance lease need to further classify into finance lease involving financial lessor or lease involving manufacturers or dealers. So this is another further classification of finance lease. So let us look at this example 10.5, 10.6, and 10.7 from the textbook. This is illustrative example from the textbook, example number 10.5, extension from the previous example 10.4. So using the fact from the illustrative example 10.4, okay, assume now that the lease is cancelable, can be cancelled, but cancellation will incur a monetary penalty equivalent to 2 years rental payment. If you cancel, then you have to pay 2 years rental payment. So the directors of Book Limited have indicated that they intend to return the asset to Phase Limited at the end of the lease term. So how will the lessor classify this lease? Okay. So the answer is the lease must be classified either operating lease or finance lease based on the reward and risk associated with the vehicles. Okay. To help with this test described above to determine whether the lease can be classified as finance or operating lease. Number one, there is no purchase option. Mean the Book Limited does not have any options. Okay, they don't have given an option to buy the assets. So the purchase option test failed. That's number one. Okay. And it's expected that the asset will be returned to the lessor. Okay. Book must return the asset to Phase Limited, okay, at the end of the lease contract. Okay. The lease agreement is cancelable. Yes, you can cancel the lease agreement, but significant amount of money, monetary penalty, that is 2 years of rental payment, will apply to this lease. So although you can see that penalty is included in the lease payment to make sure the lessor losses associated with cancellation are borne by the lessee. Okay. So the cancellability test pass. Yeah, this one is passed. The lease is 4 years, which is 66.67% of the asset economic useful life. Then the question is state that the asset useful life is 6 years. Okay, you lease for 4 years, that is 2/3 of the asset's useful life. So if expected benefit were receivable evenly over the useful life, it may be argued that the lease arrangement is for the major part of the asset, that is more than 50 years, more than 50%. That is, the risk and reward associated with asset have been transferred to the lessee. So lease term test pass. Yeah. And next is about the present value of lease payment. If you look at this present value of lease payment, we paid 85,457, which is equivalent to 95% of the assets value, the fair value of the asset. So in this case, we can say that lease payment is considered to be substantially all the fair value of the underlying asset. So this fall under the present value test. So this present value test also give you a pass result. So from here, if you look at this, you will know that the application of the guideline provide mixed result. Okay. The key criterion in classifying lease is whether substantially the risk and reward incident to ownership have been transferred or not. So based on this analysis, we find insufficient information to do this, yeah, because different signal come from the lease term, and the present value may be due to the fact that majority of reward will be transferred at early stage of the life of assets, for example, in case of motor vehicles here. So the mixed signal demonstrate that guideline must be used for guidance only and not treated as specific criteria that must be met. Given no extra information, it's concluded that the lease payment may be classified as a finance lease because arguably substantially all the risk and reward incident to ownership have been passed to the lessee. Yeah, we have passed the risk and reward to the lessee, but it's not conclusive. Why? Because we have very limited information over here. Okay, that is the example 10.10.5. So if you want to go further on these topics, the detailed guidelines, you should go to this page here, this page, and see the classification guideline as provided under paragraph 63 of AASB number 16. Yeah, that is the list transfer about whether you should classify the asset as a finance lease. So this is just the basics, yeah, the basics criteria here. And then this is also another para 64 also provide additional guideline where situation could lead to a finance lease. This is normally lead to a finance lease. We have 5 criteria, and then we have another 3 criteria on whether it should be classified under finance lease or not. So please do your revision on this, yeah, on this. So when a lease is classified as a finance lease, it means that the lessor transferred substantially all the risk and reward, yeah, incidental to ownership of the underlying asset to the lessee. So the lessor should derecognize, mean remove the underlying assets from their financial statement, from their balance sheet. Record a lease receivable. Instead of maybe vehicles, they now change the item to lease receivable to reflect the amount of money they expect to receive from the lessor. So instead of vehicles now, or motor vehicles, now they have a new asset known as lease receivable. Lease receivable is the amount of money expected to be received from the lessee. So that is in case of finance lease. Finance lease, where substantial amount of risk and reward, incidental to ownership have been transferred to lessee. So the ASB defined the net investment. This is the initial recognition, whereby the net investment is the gross investment in the lease discounted at the interest rate implicit in the lease. It defined the gross investment in the lease as the sum of the lease payment by the lessor, lease payment receivable by the lessor. Number 2 is unguaranteed residual value. So this is the component of the gross investment. For the subsequent measurement, as the lease payment are received from the lessee over the lease term, the receipt need to be analyzed into two components. If when we make accounts for lessee for amount 22,000, we have to break it into the interest component as well as reduced in liability component. Same goes for the lessor, okay, in finance lease, whereby the amount of money received must be split into the interest revenue earned. The amount from the interest, maybe 7%, 7% of the amount is the 7% from the balance is the interest revenue earned. This 7% is come from our example before this, and the balance will be a reduction of the lease receivable. This is your lease receivable. This one I'm going to credit my lease receivable, and the balance here, this one is your revenue, your income, your income as interest revenue. Okay, let us look at more examples from the textbook. Okay, this is examples from the textbook, from Loftus textbook, example 10.6. This is a continuity from what we have done before, example 10.4 and 10.5. The question asks you, what are the journal entries recorded by Phase Limited to recognize the lease and the related receipt through the lease? As demonstrated in the 10.5, Phase Limited classify that lease as a finance lease. So you need to remove that lease, that assets, vehicles from your from Phase as financial statement assets, and record the receivable, the lease receivables. So the lease receipt schedule start with the balance of the lease receivable at the start of the lease that should capture the present value of lease payment and the present value of unguaranteed residual. So from this process, you have here 85,457. This is the lease payment, plus the unguaranteed residual is 5,722. So the total present value is 91176. And at the beginning of period, you receive a payment of 22,000, and always remember that 7,500 and 7,500 are guaranteed and unguaranteed payment, and we use the interest rate of 7%. So from 91,000, 91,000 on 30th June, you receive payment of 22,000. No interest yet, because this is the once you sign the contract with the lessee. So all the 22,000 will be deducted from your receivable account. So now on 30th June 2022, the expected receivable amount is 69,176. Later on, you receive another 22,000. I hope you still remember. This one is 23,900 plus minus 1,900 executory cost. So 22,000. Now you need to break down this 22,000 to component, the interest revenue component, and the second is a reduction in receivable component. So 69,178, multiplied by 7%, you get 4,842. So this is the interest revenue. This amount 4,842 will go to your income statement, and 17,158 will be deducted from your receivable balance. So that's why your receivable balance is 52,020, and this continue until the end of the contract. So this is the accounting for lessor in the context of finance lease. In the context of finance lease, we recognize the asset from the vehicles, maybe from the balance sheet, and then we recognize the lease receivable as assets. Okay. So what will be the journal entry as expected? The first one, on 30th June, you will, okay, for example, you purchase the vehicles. So debit vehicles, credit cash. When you sign the contract with the lessor, you're going to remove that asset. You're going to remove that asset from your balance sheet. So that's why credit vehicles 89721. So this is remove of the recognition of the assets. And then you're going to recognize that 89721 as your lease receivable. Lease receivable 89721. And then we have payment of IDC, indirect cost, debit, lease receivable, credit, cash. And then you continue with other transactions here. Yeah. For example, cash payment, 23,900. Yeah. This is the cash payment, but the component of lease receivable is 22,000, whereby 1,900 is reimbursement in advance. This is the cost of insurance, yeah, and maintenance for the asset. So we put here under reimbursement in advance. Yeah, that's the liability for the lessor. And then we're going, once you complete the process later on, you're going to transfer the liability as your revenue, and it continues like. Until the end of the term, where you are going to record the reimbursement as usual, and then finally vehicles, you're going to debit by 15,000, and then the interest part will be 983, and 14017 is the lease receivable. So no more lease receivable. You have completed this, and this 15,000 is the residual value, is the value of the assets one written by the lessee. Okay, thank you.